Well, hi, natural gas traders. Let's talk about hedging. Hedging just means protecting your position, as in sort of hedging your bets, or more literally, growing a hedge or a protective fence around the trades that you're taking. Let's go back to the very beginning of this trade. You remember natural gas dropped down to the $3.50 level after a prolonged move down. This is the 4-hour chart. We started to form a support along that level, and that's where a lot of buyers came into the market. After a couple of days, the price broke through the bottom of that channel and stopped a lot of people out and stopped me out. A lot of people held on to their losing positions as the price started to go down. You can see the price broke down through there, back tested it as is usual, and then continued to move lower down towards the areas where we are at right now. We broke through that first support zone, broke through the second one, hesitated there for a while, and we got down into this third zone at around $2.20 or $2.40. It hung around there for a little bit, and then eventually we got down to the $2 level. And that's where this hedging story starts. My first trade, as I said, was stopped out. I then re-entered the market at just around about $2, at $2.10 to be precise, after this 4-hourly candle broke up above $2 after testing it below very briefly. I got into this trade long at $2.10. I had my sights set on $3 as a potential exit point for this trade, or a potential continuation and a breakup through $3 back up to that $3.50 level that we were talking about earlier, this pink zone here. So when we moved up to $3, I entered a short hedged position against my long position from $2.10, wondering whether the market would break up through here or move down afterwards. As it turned out, the market opened with a big gap lower and we began to move down from there. So now at that stage, I was long from $2.10 and short from $3. After a period of time had passed and we didn't see any inclination to move up through the top of this channel or through the 50 and 20 period moving averages shown in red and green over here, and also bouncing around the 200 period moving average and not making any progress above there either, I then added an additional piece to my short hedge. That addition to my short hedge meant that my short position and my long position were equal in size, and that's where this hedged position has remained up until now. So I'm long from $2.10, and the average short price is $2.95 after adding that little bit more in at $2.70. As time has since progressed, we've just begun to move lower and lower, and we've broken steadily down through these support lines and held beneath this trend line and the various moving averages. And on here, I've got the 20, 50, 100, and 200 period moving averages, and we haven't managed to break up above those at this stage. We've now moved all the way down to where we are currently. We did see a break up through this trend line, and we back tested it from the top, but we haven't managed to move up through the 50 period moving average or the top of this channel, and we're hovering around near the bottom of this zone just above the descending trend line. So that's the picture in a nutshell. And now what I want to talk about is how I'm planning to manage this hedged position and what my strategy is to use this hedge to my advantage to profit even more from this trade. Bear in mind that both of these trades are currently in profit. The short from $2.95 average price and the long from $2.10 are equally balanced. That one's in a little bit of profit, the $2.10 long, and the $2.95 short average price is in a lot more profit. So let's zoom out and have a look at the bigger picture. It's important to note that hedging is not necessarily useful in all sorts of markets or all types of trading conditions. However, when you have a directional bias and a good probability of the market heading towards a certain level, that's when hedging can become very useful. And I use hedging in things like natural gas or US dollar yen, where I believe that the yen is going to strengthen over the coming year. I don't know what the levels are precisely, and the same with natural gas. I believe that the natural gas price will eventually strengthen. I don't know how far it's going to go down before we move back up again, but I do believe that we're going to get back up to about $3.50, $3.60 or $3.75. I'd encourage you to have a look at the video that's linked at the end of this video so you can get an idea of why I've picked these levels and why I have a target at $3.50. It's really important that you understand that so that you can place this hedging strategy in context of what the overall market is likely to do. So we know what the overall target is, $3.50, 60, 70, somewhere around there. And we know where the support levels beneath us are, from which at some stage we'll eventually probably get a bounce and start moving up towards that level. I want to take advantage of this move higher. I don't want to be out of the market. I want to keep my trades open, and I want to be actively involved in what's going on in this market. So let's take a look at the strategy that I'm going to use. It's really simple, actually. I'm going to adjust my hedge as the market moves. However, I'm only going to adjust my hedge in one direction, and that's in the long direction because that's where I believe the market's ultimately moving to. So that's taken half of the decision-making process away from me already. I'm not going to be weighting my hedge towards the short side because I have my target set above us. So I'm only going to be weighting my hedge to the long side if and when we get the opportunity to do so. If I do add long positions to my hedge and the market begins to move against the long side, in other words, we start breaking down through support further, I can take those long positions off and return to a neutral position. I could even take additional long positions out of my hedge in order to weight my overall hedge to the short side. But the only additions I'll be making to the hedge will be to the long side. So that makes that really simple, that choice. We don't have to think about adding short positions. We only have to worry about adding the long positions to the hedge. So I'm going to try and explain this in under 5 minutes because it really is that simple. I've defined our areas of resistance above us, and every time we break up through those resistance levels, bounce off the top and continue in that direction, making higher highs, etc., at each one of these levels. First of all, we've got to get through the one that we're in right now. Then we've got to get through this higher one at around 240. Then we've got to get through the 265 level. Then we've got to get up to the $3 level, and above there, that's going to be the toughest one. And then we need to eventually get up into the $3.40 to $3.75 levels. So there's a lot of work for natural gas to do in order to get to our target, and it could take a very long time. As you will have seen in the previous video, sometimes natural gas can hover around at the levels that we're at now, and even lower, for weeks and even months on end. So we have to be aware of that, and we have to be patient, and also just not get stressed. There's time for this to work out if you're in this sort of hedged position. That's one of the beauties of being hedged, is that it gives you time to consider your position, to work it out quietly and gently, and go along without added stress and aggravation when you're taking your trade. So we want to see moves up above these levels. We want to see bullish candles. We want to see good candle patterns. We want to see breaks above these moving averages, a move up, and then a back test from the top. Now, the 4-hour chart's a very good chart to use to determine these moves, but you could use a day chart as well. I sort of oscillate between a 4-hour and a day chart. If I want to see what's happening in finer detail, I'll look at the 4-hour chart. But overall, I try and make my decisions once a day, once the daily candle is closed, because that gives me a good perspective. And I like to look at the daily candle patterns. I've explained before the reason why I use candlestick patterns, particularly in commodity trading, and you can have a look at that in one of the previous videos. But really what we're looking for is the market sentiment in a market that's actually rooted in emotion and greed and digging things out of the ground and all that sort of thing. I've spoken about it before. And the candle patterns really reflect that sentiment very well. So we want to see these candles on the 4-hour chart or the day chart closing above these levels, back testing from the top, holding, and then moving up. And as that happens, I will adjust my hedge accordingly and start to add long positions to my hedge or remove short positions. In that way, I will be able to add to my profit in this trade, which is now fixed at a certain level. But as the market moves up in my favor, I'll be adding to a winning position, which is something that traders often don't do. Many traders are willing to add to losing positions, but there's a very good argument to be made to add to winning positions, because when the market's going in your favor and you're right and you're in the right direction, you want to capitalize on that move and make sure that you can get the most out of it. So as the market moves up and holds above these support levels, which were resistance, I'll then begin to adjust my hedge in the favor of the long side. When we get to $3, I may take off some of those longs in anticipation of a move back down to retest support. Remember, the market moves in waves, so we're not going to move up in a straight line. We're going to move up, back test, move up, back test, move up, back test, all the way up to our target. And when we move up, we can get rid of some of the long positions, return to a slightly less aggressive hedge, and then add back into those long positions if we back test these supports from above and manage to hold and continue to move up. Then we can reassess and potentially reweight our positions more in favor of the long side again. On the other hand, if we break down through these support levels, and there's a big danger of that happening, we know where the support levels beneath us are because we've done our work, we've done our technical analysis on the charts, and we know that we've got one at $1.80 and $1.50. $1.50 pretty much being as low as it should go. It could go a little bit lower. I don't think so, though, because this is kind of the all-time low. It has dipped below there once or twice, but very briefly and not by very far. We know that 150 is kind of the floor for this. We know that 180 will probably provide some support. We could get down to 150. As we start moving down, I can just leave my hedge as it is. In other words, perfectly balanced, and not make any adjustments to my profit or loss. That would be my preference. And then I would consider potentially adding more to the long side of the hedge only when we get down to $1.80, and even better if we get down to $1.50. And I can put those hedges on with stop losses beneath each of those levels. So I can have a combination of an overall hedge, and I can add to that hedge to the long side at these levels. But if those levels break, I can remove those extra long positions that are added on and return to a neutral position. In other words, basically stopping out the fresh long trades that I've added on. So we have a combination of an overall hedged position together with positions within that hedge that I can take off if the market moves further against us. And of course, if we get to $1.80, I might adjust my hedge in favor of the long side. But if we get to $1.50, I'll be even more aggressive in adding long positions to the hedge because I know that this is a kind of extreme floor that the market might move to. And then if we start moving up from there, we repeat the whole process from the beginning. Then I'll be in a better position than I am at the moment because I'll have extra long positions. I'll be weighted to the long side. And then as we begin to move up and challenge these resistance zones above us, then we can start to readjust our hedge as we move up in the same way that I described earlier by adding or subtracting long or short positions as we move higher. Ultimately, the ideal trade for me in my position would be a move down without adjusting my neutral hedge at the moment and a bounce off one of these two levels at $1.80 or $1.50, the opportunity to add extra long positions to my hedge and then manage those as we move up through these levels towards our target at $3.40, 50, 60, or 70. Bear in mind, as I said earlier, that the market will move in waves. So at some stage, we'll get a move up through these resistance levels, a back test from the top. We can take off long positions when we reach resistance and add them back on again when we reach the support beneath us, and then continue to do so as we move higher through these somewhat challenging levels, with the biggest challenge being overhead here at $3 and then eventually into $3.50. And when we get to $3.40, 50, 60, or 75, I'll remove all of my trade positions and exit natural gas completely for the time being. So that's hedging, and I apply this to markets where I'm pretty confident, pretty certain, pretty secure of an overall direction and an overall floor in this case and a target. The same applies to dollar yen, for example. For those of you who trade dollar yen, I'm pretty sure that the dollar yen will begin to move down throughout 2023. I kind of know where the ceiling is, and I kind of know where the target is, and I know the direction is short on that particular currency. The same with natural gas. I know where the floor is, I know where the ceiling is. I'm aiming for the ceiling, I'm not aiming for the floor. By choosing and picking a direction, in this case, I take away half the decision-making process. I only want to be looking to add long positions to my hedge. I know where my target is. The reason I'm not trading it short is because we're much closer to the support levels than we are to this resistance level. So the risk of going short or weighting my hedge to the short side is greater than going long or weighting my hedge to the long side. Well, I hope you found that useful. It's a little bit difficult to explain when you're not looking at someone, when you're just looking at your screen, but it's actually a really simple principle, and it's really well employed in a market, as I said, where you know where the floor is and you know where the ceiling is and you know where your target is. In this case, I'm aiming from floor to ceiling. In the case of the US dollar yen, I'm aiming from ceiling to floor, and I employ hedging there as well. You can apply this hedging strategy to many markets. Commodity markets are particularly good because we get extremes in commodity markets, and you kind of know when we get to extreme levels that the market is likely to turn and change direction. The problem is that we don't know what the timing is, and we don't know how far extended these markets can get. Remember that commodity markets in particular can be very volatile, very wild, very irrational, and they will not do what you want them to do or expect them to do a large proportion of the time. And that's why you need to protect your trade and protect your investment using whatever technique you feel comfortable with. And in my case, I prefer to use hedging to mitigate risk and to maximize profit. If you found this explanation on hedging and natural gas useful, please give the video a thumbs up and consider subscribe to the channel. Take care.